Good evening, ladies and gentlemen. I'm Christine from SIAS. Thank you for joining us at Corporate Connect this evening. This webinar is organized by SIAS and supported by SGX. Today, we have with us Mr. Jeff Howie, Market Strategist from SGX, to share with us on market up, followed by a presentation by Mr. Chen Feng Ling, Vice President, Investor Relations, Fraser Centrepoint Trust. And we will end off with a Q&A session moderated by Mr. Benjamin Goh, Head of Research and Investor Education from SIAS. Without further ado, let us welcome our first speaker, Mr. Jeff Howie from SGX. Over to you, Jeff.
Thank you very much. Let me bear with me while I get my screen up, and that should be all good to go. So thank you. The presentation is going to be a quick 25 minutes before Fraser Centrepoint Trust do present. And this one is going to be, I guess, well, I better take my WebEx off. Sorry. So let me close it because I don't want to bother everybody. So the presentation really, as we said, for 25 minutes is going to be looking at the recent observations in the stock market, some of the recent drivers of Singapore stocks, which obviously include COVID-19 constrained growth, interest rate expectations, the global trade growth we've seen, as well as the surging demand for technology, supply and demand for commodities, as well as, of course, corporate efforts to maximize operational efficiency. Now, they're the key drivers of the market here in Singapore at the moment. Obviously, we don't have time to cover them over the next 25 minutes or so. So we'll endeavor to race through as much as we can. Predominantly, I guess, the road to recovery of not just Singapore, but the global economy and the resilience of global capital markets. Globally, this has had a profound impact on the stock market here this year. So the STI has generated a 17% total return in the year to date, and I think regional and global trade, we obviously know it's a very important aspect of the Singapore economy, but that it also extends very strongly to the stock market. The stock market is amongst the world's most diversified stock markets when you do consider the span of countries that the stocks either report their revenue to or base their assets in. Singapore's ASEAN neighbours account for 20 to 25% of our total trade value. And of all the regional and global stock market indices, we are most correlated to the FTSE ASEAN All-Share Index. And that correlation is, of course, built on both economic connections and institutional portfolio flows that track our mutual parent regional indices. So the FTSE All-Share Index also has Singapore stocks making up 25% of it, reinforcing the correlation. Now, one global market that is, I guess, attracting a lot of attention going into 2022 is the US dollar. And the US dollar has made a 16-month high last week and now up some 6% in the year to date after declining 7% last year. The IMF flagged in October that a faster than anticipated normalization in US monetary policy could increase downside risks to growth in many Asian economies, especially emerging market and developing economies. However, at the same time, macroeconomic fundamentals play an important role on the magnitude of that potential spillover effect. Larger spillovers in countries would be expected with those countries that maintain lower reserves, higher external debt, and I guess higher public debt. But nonetheless, the IMF estimate that Indonesia, Malaysia, the Philippines, Singapore, and Thailand are expected to generate 3% growth this year, followed by 5.5% growth next year and 5.7% growth the year after. So that's a very different delta to Asia's emerging markets as a whole, which has the Asia emerging and developing economies estimated to go down from 7.2% to 6.3% next year, and then further down to 5.7%. So as I said, this stock market is highly diversified with a lot of exposure to these relevant countries, but it also very highly diversified across the various sectors and the industries that make up the market. As shown in 2021, those sectors with businesses that have been able to really grow their revenues amid the COVID constrained growth have outpaced those sectors with businesses that have obviously faced more obstacles. Globally, semiconductor demand and digitalization has seen technology stocks lead the global stock market, while resilient investment has seen banks also among the strongest sectors. On the other hand, the challenges of commercial real estate and hospitality have seen the real estate and hospitality businesses amid the least performing sectors of the year. However, with the coronavirus, the overarching theme of the year, and now, 7.5 billion vaccine doses administered across the world, expectations of a more normalized 2022 have some rotations in the fourth quarter to date. Notably, the global hospitality sector has outpaced the global bank sector over the past 6 to 7 weeks. So, looking at the global cues that are really driving sectors, as shown in this table, in the second half of this year, it has been a much more mixed performance for the different sectors of stocks listed in Singapore. These sectors are representing the 200 most traded stocks here in Singapore, which make up not more than 90% of our day-to-day turnover and around three-quarters of our total market cap. So this is not all the 700 stocks. This is just the 200 most traded, categorized into the various sectors that they represent. Now, that, I guess, more mixed performance in the second half versus the first half, it has really been a global development with, I guess, the concerns of the continued growth of COVID-19 cases on the developing or the decelerating sequential economic growth, which has really been reinforced by the fact that economies are still seeing resurgences of COVID-19. Some big parts of the world, such as China and Hong Kong, have the zero COVID policy. And importantly too, the 7-day rolling average of daily new global confirmed cases of COVID-19, it has still not broken below that 350,000 level a day mark. And that's been the case since October 2020. So despite global vaccine progress, that is a key level that needs to be tackled in 2022. As a key aspect, I guess, of the varied sector performances this year has, of course, been the global demand and the supply disruptions to commodities this year, which I'd like to just quickly touch on because through the prism of the management of these companies and their outlooks for the next 12 months, if you look at it, gains in commodities prices this year, they have largely been driven by the COVID-19-led constrained supplies, and other drivers have included industrial sectors recovering faster than consumer sectors, agricultural stockpiling, OPEC supply management, in addition to the decline in the US dollar index for most of the year. And that's provided that benchmark pricing, remember the US dollar, for most of global commodity markets, and thus maintains a direct impact on the cost of commodities and spurred on a lot of demand we saw for it earlier in the year. So what this means is that the energy sector, it was the strongest performing sector across the globe in the third quarter and has been the strongest segment of the most actively traded stocks in Singapore in this year. Much of the oil price gain, it has been attributed to the IMF, to the global economic recovery, which remains an upside risk, of course, along with lower global production capacity from reduced investment in oil wells in the last 2 years, and OPEC price support as well being an upside risk. But at the same time, downside risks to the price of oil really include the economic impacts of resurgences of the Delta variant, higher output from uncommitted OPEC members, and higher output, of course, from the US shale producers. So that are the key drivers for this sector, which has been our strongest and most consistent throughout the year. And those stocks, obviously in the energy sector, some of the most traded stocks, they include obviously Rex International, RH Petrogas, Golden Energy Resources, Geo Energy Resources. Now, the trio of DBS, OCBC, and UOB, they mark up 40% of the STI, so they've been a big part of the 17% gain this year. They also make up 20% of our day-to-day turnover. They make up 20% of our total market cap. The trio have averaged 23% price gains in the year to date, with dividends increasing that average total return to 27%. Now, that has been in line with global banks that have also generated a 27% total return over the time frame. And for the majority of the year, global banks or the trio and the global banks have been more or less in line. For the region, though, regional banks have trailed a little bit. They're up 14% in the year to date. And at the same time, DBS, OCBC, and UOB have been recipient to $1.6 billion of net institutional inflows this year. All three provided third quarter updates earlier this month. The combined net interest income of the trio came to 5.17 billion, which is up from 5.13 billion in the preceding quarter. For the entire 9 months, this net interest income made up 57% of DBS's total income. It made up 54% of OCBC's total income and 64% of UOB's total income. The trio also maintained higher return on equities at the last filings than both the regional and the global average for the bank sector, according to Bloomberg data. Compared to the previous quarter, the third quarter customer loans were up 4% for OCBC, 3% for UOB, and 2% for DBS. And all three banks reported significant year-on-year declines in allowances for the 9 months, which was an important part of their overall net profit numbers. On the results, the DBS CEO noted a progressive normalization of interest rates in the coming quarters will be beneficial to earnings, while asset quality continues to be resilient and total allowances are likely to remain low. OCBC CEO, she noted that in the third quarter, the momentum across OCBC's banking, wealth management, and insurance businesses continued to grow, as reflected by the loan, net new money, fee, and insurance sales growth. Meanwhile, UOB CEO noted that amid the near-term uncertainties, the gradual reopening of borders does bode well for business flows, and the bank remains positive of strong activities along the Greater China and ASEAN trade corridors, with connectivity, digital innovation, and sustainability areas set to drive Asia's growth for the decades to come. Moving on to the sector that will be celebrating 20 years of since its establishment next year. For the past 19 years, Singapore has grown to be one of Asia's largest REIT and property trust markets. We list 33 REITs for trading, in addition to 5 staple trusts and 2 business trusts that are investing in properties. As of the end of August, the combined market, it's not the end of August, as of the end of November, no, the end of October. Sorry, getting my timing all wrong. Since the end of October, the combined market value of the S-REIT sector stood at 113 billion Sing dollars, and that represents around 12 to 13% of the combined value of all our stocks listed on the exchange. As many as 16 of the trusts exclusively invest in property assets outside of Singapore. 19 of the trusts invest in both properties in Singapore and outside Singapore, and the remaining 5 are investing purely in Singapore. It includes as many as 10 trusts with properties in China, 7 REITs with properties in Japan, 6 REITs with properties in Malaysia. And the trusts are also very highly diversified across property types, with a balance across retail, industrial, office, and hospitality properties, in addition to multiple REITs investing in healthcare-related properties. And of course, we have specialized REITs that are looking at data centers. Now, resilient investment has been, as we said, an overarching theme of the global stock market this year and the local property market as well. And this has impacted the adjacent financial sector, as we said. It's also impacted real estate agencies and, of course, real estate investment trusts that have been basically expanding their portfolios. There have been close to 20 REITs so far this year that have made acquisitions with deal values close to 9 billion Singapore dollars. Now, today was a new listing of ETF. It's the UOB APAC Green REIT ETF. It has an AUM of more than $80 million, and it brings the number of REIT ETFs listed for trading on SGX to 5. Their total AUM is around 780 million Sing dollars, and that represents an 80% year-on-year increase. The underlying index of this ETF is the iEdge UOB APAC Yield Focus Green REIT ETF. It focuses on environmental indicators when assessing these REITs: energy consumption, water consumption, greenhouse gas emissions, and green building certifications, while also maintaining a competitive dividend yield. Of the 50 constituents of the index and the ETF, 9 of them are listed in Singapore. It includes CapitaLand Integrated Commercial Trust, all 4 of the Mapletree Group sponsored REITs, Fraser Logistic and Commercial Trust, Suntec REIT, Keppel REIT, and the business trust, Ascendas India Trust. Now, it provides for a diverse representation of our S-REIT sector, and while the iEdge UOB APAC Yield Focus Green REIT Total Return Index has recovered from its pre-COVID-19 levels, not every constituent has recovered. For instance, REITs that thrive with open borders like Suntec REIT are still trading below their early 2020 highs, while others that cater to trade and logistics rather than consumers and hospitality recovered earlier. For instance, Mapletree Industrial Trust had recovered from its March 2020 highs within 3 months. Sorry, it had recovered within its March 2020 lows within 3 months. With the uneven economic recovery, an unfortunate symptom of obviously the COVID-constrained global growth, both Suntec REIT and Mapletree Industrial Trust have diversified 5-year annualized total returns. I think for Suntec REIT, it's 5%. For Mapletree Industrial Trust, it's 18%. So while the IMF outlook marginally, I guess, trimmed its global growth outlook for 2021, I think down to 5.9% from 6%, the above average 4.9% growth rate for next year remained intact. And similarly, in Singapore, GDP is expected to grow between 6 and 7% this year and remain above trend in 2022. Now, the overarching market drivers are present, as we said, efforts to contain COVID-19, the global growth outlook remaining largely intact for this year and next year, while these rising commodity prices, supply disruptions, and the continued local focus on strategic restructuring are providing the market cues. Nevertheless, the growth in the trade-related and the modern services sector is expected to be supported by the resilient electronics cycle and improving business activity. And meanwhile, some improvement in conditions in the domestic orientated and travel related clusters are also expected to come to fruition as we make our transition into this basic I guess norm of managing COVID-19 as an endemic. Now this week, last week was very quiet for the STI. Last week's trading range for the STI was the second lowest for a week that we've seen in the last 5 years. And predominantly, you could say because we've got a number of really big numbers this week. The first was today. We had the CPI. Tomorrow, 8 a.m., we have our final GDP number for the third quarter. And then on Friday, we have October industrial production. So Singapore's October CPI was expected to grow by 2.9% year on year. It came in a little higher at 3.2% year on year. Core inflation was expected to increase 1.4% year on year. It came in at 1.5%. You might recall in the October MAS semi-annual monetary policy statement, the MAS noted for a whole this year, the measure for core inflation was expected to come in near the upper end of the 0 to 1% range. And then next year is expected to increase further to the 1 to 2% range. Inflation has been in the spotlight globally. China's PPI for the month of October was its highest level since August 1995. And that was on higher imported inflation and the tight domestic supply of major energy and raw materials. And in the US, the October CPI was at its highest level since December 1990. And that was really led by transport-related prices. So the drivers of inflation have really added fuel to the transient camp, the group of economists that believe inflation is transitory. The US CPI obviously attributed really to the reopening pent-up demand, while China PPI attributed to the supply constraints and commodity demand. Key commodities also, they're not in contango, which is where the futures price of a commodity is higher than the spot price. On the coal front, our SGX traded M42 futures index currently show coal prices for next year to be around 45 to 55 US dollars per ton. And that's down significantly from $80 to $115 per ton that it was that we were looking at the end of September. And similarly for European crude Brent futures, they continue to trade around the SEP levels as well. So at around $70 to $80 barrel. So what we've seen is those energy plays that have really moved with those supply constraints really start to contain their year-to-date gains. I think Rex International trimmed its year-to-date gain from 147% back on the 25th of October down to 112% year-to-date as of the Friday close last week. And similarly, RH Petrogas trimmed its 2021 year-to-date gain from 720% on the 26th of October to, I think, 580% on the close last week. Now, the GDP is going to be really important tomorrow at 8 a.m. Advanced estimates that we had it up 6.5% year on year, and that was largely computed from data in July and August. And the preceding second quarter final GDP, that came in higher than the advanced estimate by 0.4%. But the advanced 3Q GDP report showed that manufacturing growth during the quarter was supported by output expansions in all clusters except for the chemicals cluster. And in particular, the electronics and precision engineering clusters continue to post strong growth. And that was driven by global demand for semiconductors and the equipment, as we mentioned. And that really did also transcend into the third quarter business updates for our semiconductor related companies. UMS reported its third quarter financials hit new peaks with revenue, I think, surging 50% year on year, and its net profit was up 25%. Franken's third quarter semiconductor sales within its mechatronics division, that they surged 43% year on year, and AEM also highlighted that volume ramp in system level 21 revenue guidance to 525 million to 550 million, which is up from the 520 million record revenue last year. Construction, accommodation, food, wholesale, retail trade sectors, they are expected to remain below pre-COVID third quarter FY19 levels, or I should say third quarter 19 levels. And those segments will take more of the spotlight, obviously, in 2022. The advanced third quarter GDP showed that in absolute terms, the value added of the construction sector remained 25% below its pre-COVID third quarter 2019 levels, with activity at construction work sites obviously weighed down by labour shortages due to the border restrictions on the entry of migrant workers. Nonetheless, the advanced print did show that the construction sector expanded close to 60% year on year in the third quarter 21, and that was a low base effect. But since the end of September, should also mention Financesg and Basted projects have both generated respective returns. I think Financesg close to 5%, Basted projects at 7.5%, and both stocks have seen net institutional buying totaling close to 1 million in net inflows. And then on the accommodation and the food services and supportive sectors, I guess on the tourist front as well, Straco has noted during last week as well that, like all operators in the tourism and hospitality sector, it is cautiously optimistic that business environments will continue to gradually improve with the further lifting of restrictions. And finally, on Friday, there's October industrial production expected to increase by around 14% year on year. Business expectation report released last month showed that with the manufacturing optimism in the market is largely led by the semiconductor segment, and that is expected to see continued robust demand from the 5G market, from cloud services and data centers. So the three manufacturers really also have dominated the net institutional inflows last week. The three technology manufacturers, I should say, AEM, ST Engineering and Venture, seeing close to $80 million in net institutional inflows. So there's a quick wrap in terms of numbers coming out this week, the key drivers that we're looking for, as well as some insight into what companies are saying around those numbers. If you'd like to know more on those particular segments, such as the energy or the semiconductor related stocks, the banks and the REITs, please do follow us on our social media and our email reports, which see us are basically helping us to report and to publicize as well. So many thanks, and really looking forward to this presentation from Fraser Centrepoint Trust coming up right now. Thank you.
Thank you, Jeff, for sharing. And next, we are pleased to welcome Mr. Chen Fong Ling, Vice President, Investor Relations, Fraser Centrepoint Trust. He will share with us more about the company. Mr. Chen, please.
Yeah, hi. Thank you, Christine. Good evening, everyone, and welcome to the presentation. Very happy to be here. So let me just wish everybody a good health. I'd like to just give a very quick overview of Fraser Centrepoint Trust for those who may not be familiar with us. We have been listed on the Singapore Stock Exchange since 2006. So we are actually quite more than 10 years on the SGX main board. Current market capitalization is roughly about $4 billion. So that places us among the top 10 largest S-REIT by market capitalization. Our portfolio is purely retail portfolio. You can see the dots that's shown on the maps here. There are 9 dots there. And total, you can find 9 well-located suburban malls with a total of about 2.3 million square feet of net lettable space. We are one of the largest suburban mall landlords in Singapore. And you'll find that for those people who live in the northeastern, or even the east, you may be very familiar with some of our malls. All these malls are well located on or next to MRT stations, and therefore they enjoy pretty good and healthy occupancy as well as high recurring shopper traffic. If you kind of look at the circular circles on each of the red dots, those represent the catchment, and if we aggregate the population around all this catchment, it represents roughly about 2.6 million catchment population. That's roughly about half of Singapore's population. Retail portfolio committed occupancy as of the end of September was 97.3, so a pretty good healthy occupancy. Next up, this is a picture of the 9 malls, and the 9 malls itself, 8 of them are BCA Green Mark certified gold and above, and 4 of them are actually platinum, Green Mark Platinum rated. This is actually currently the highest tier in terms of the Green Mark certification. The largest mall is Causeway Point, and that's located in Woodlands. And the second largest, as you can see, is Waterway Point. That is located in Punggol, and for those people who live in Punggol or northeastern part of Singapore, you may be very familiar with the mall. So the rest of them, you can see they are mainly located all in the next or on MRT stations, and some of you all may be very familiar with them. In terms of portfolio mix, we are focused on essential services. Around 54% of our gross rental incomes are focused on essential services that comprises F&Bs, some of the services like dental, medical services, barbers, and supermarkets, beauty and health. And essentially, all these essential services are what the Ministry of Trade and Industry has classified as essential services during last year's circuit breaker. And these are the trades that were still allowed to open or operate during the circuit breaker. So if you recall, during the circuit breaker last year, between April 7th to 1st of June, those non-essential services were asked to shut, except for those which people need on an essential basis. They need it to access for food, key essential services. So this kind of trades represents 54% of our product mix. And also you can see that this proportion is slightly higher than what a typical suburban mall in general will be, and also much higher than those in the city area. What this essential services give us is really the resilience, because these are the day-to-day services, products and services that people need. So they have to access it, through the malls, and this basically underpin the resilience as well as when the circuit breaker recovers, reopens, they're also one of the first to recover, and that helped us to recover in terms of tenant sales very quickly. A bit of a history, we were listed since 2006. So this gives you a history of the DPU. You will notice that every year since 2007 up to 2019, every year has been a growing DPU year. And both the DPU and the NAV, which is the gray boxes indicated there, have been growing. Last year was obviously an extraordinary year. We were hit by COVID, just like the rest of the industry. Retail and hospitality were particularly hit on the front line. So Our DPU dropped quite massively. You can see it drops almost 25% from the height of 12.07 cents down to 9.402 cents. Mainly because there were a couple of reasons, one of which is because the mandatory rental rebates that all the commercial landlords are mandated to provide to their tenants, that amounts to about 2 months. And on top of that, there were also a drop in terms of tenant sales and the restriction in terms of the those atrium sales and so on. So those hit us quite badly. And but during that year, we also did completed one of the largest, if not the largest, fundraising to finance a major acquisition that we did last year, which was a $1 billion acquisitions of the 63.11% remaining stake in a fund called Asia Retail Fund. That Asia Retail Fund comprises 5 retail malls and 1 office building. And the completion of that acquisition was on the 27th of October. So basically since then, FCT portfolio, retail portfolio, has basically doubled in terms of size and in terms of revenue. So if you look at the 2021 financial performance, we have basically bounced back quite strongly, and both in terms of top line numbers as well. At the DPU for 2021, the year 2021 that just ended on the end of September, has basically recovered back, and is also slightly higher than the pre-COVID level. So NAV has increased. You can see despite the COVID-19, we were able to increase the NAV. So this is basically a testament of the resilience performance of FCT and its underlying performance, underlying portfolio. Moving on very quickly, this chart is a bit busy, but basically this outlines the key events relating from the some of the transition between the different phases, phase 2, phase 3 of heightened alerts. Some of those really hit us quite badly, particularly for those restrictions on the mall capacity and also on the dining group sizes. As you know, dining group sizes will hit the restaurants and those food courts and all this thing quite badly because of the capacity limit. So the recovery of the tenant sales for these trade sectors as well as the shopper traffic really depends on how the pace of relaxation of this restriction. But despite these challenges, we are still able to improve our occupancy and also bring in new tenants to our mall. We'll show you later on in the subsequent slides that some of the new brands that we were able to bring in. So the COVID has hit the retail quite badly, but some of the trades actually thrive. So the recovery of the tenant sales among the different trades are quite uneven. It's very polarized. Some actually did better than pre-COVID. Particularly those takeaways, deliveries. So in the phases of the restrictions, some of these deliveries as well as straight takeaways actually thrive quite well. So the demand for spaces for those well located and dominant malls remains quite resilient. We also look at renewals on some of the for the list that's coming up. We actually seen some strong demand, or rather some healthy demand for some of the prime spaces as the economy is reopening up. Now, moving on, you may be interested to look at this chart here. This is a chart that benchmarks FCT tenant sales versus that of the national retail sales value. So the gray line represents the national sales national retail sales value that's published by the Department of Statistics. The red line is the FCT's portfolio tenant sales. So if we kind of benchmark this through the COVID from the beginning of last year to September, which is the latest results. So you find that actually the trend tracks quite well. And for most part of the year, when we recover, for example, from June 2020, after the reopening post-circuit breaker, our sales were actually trending above the national average. And once we get into the March, April timeframe this year, because of the low base effect from the previous year, we actually saw a much stronger rebound in the month of May 2021. So of course, after May 2021, we entered into those various phases of heightened alerts, and the sales dropped back, and we dropped a little bit more than the national average, mainly because our sales capture mainly the in-store sales and not so much on the online. So we kind of underperformed that because the national sales do capture quite a significant portion of online sales, which we don't. But otherwise, the takeaway here is that the trend is quite closely correlated. Moving on, I'll just go through quite quickly about the results highlight, which was announced on the 27th of October. This is quite recent. And financial highlights. I must say that we did pretty well last year. Our revenue and NPI basically more than doubled, and it's mainly because of the acquisitions that we have completed last year. So the additional properties contributed approximately about 11 months of top line, and that provided both the diversification in terms of earnings as well as the scale. So the overall wise, our margin, our NPI margin, net property margin has also recovered from what it was last year, from 67.5 to about 72.3, which is in line with our historical average. And looking at distributable income and DPU, distributable income grew almost also doubled to about $204 million, $204.7 million, mainly due to the enlarged portfolio. And on a full year basis, the DPU has rebounded 33.7% year on year to about 12.085 Singapore cents. So this represents about 5.3% trading yield based on the closing price of 2.27 on the 30th of September 2021. Moving on to the financial positions, Fraser Centrepoint Trust has always maintained a very prudent capital management policy. You can see that in terms of managing the tall blocks of this debt maturity, we try to maintain less than 30% of total debt maturing in any 1 year. So this is part of our prudent capital management policy, and you can see that gearing level is also very benign at about 33.3%. Industry average based on the 40 S-REITs as compiled by one of the research houses in Singapore puts the average at about between 37 to 38%. So our gearing level is below the industry average. Interest cover is also very healthy at 5 times, and we have about 56% of our debt hedged to fixed rate interest. Year-to-date average cost of debt is about 2.2%. We won't say we are the lowest, but we are possibly trading for some of the lowest average cost of debt. We are rated by both S&P and Moody's. So you can see that the rating is a BBB plus, BBB stable, and a Baa2 stable. Proportion of green loans in our total borrowing is about 18%. So we have a sustainability goal to try to target to increase this proportion to more than to account for a significant portion of our borrowings going in the next few years. Next, some operation highlights. Again, this chart is quite busy, but the takeaway here is that our portfolio occupancy has rose despite the COVID situation, has rose to 97.3%. And this is mainly because of the picked up in leasing activities as Singapore work towards the normalization. But of course, we would also caveat that the retailers remain cautious because of the volatility in the community cases, and also in terms of the tightening of safe management measures. This chart is quite interesting, and it's actually quite closely tracked by the market as well as investors. They wanted to know from the chart whether the corners are turning, we are turning the corners, or whether there's still more traffic restriction to go. If you look at the left-hand side, this is the shopper traffic trend. The blue line represents what it was last year, and the red line represents this year. And the dotted line represents what is like in a normal pre-COVID situation. So in the last few months, between July to September, we are hovering around 50 to 60% of our normal traffic. right? So this is mainly because of the social distancing as well as the safe management measures that is currently still in effect. The mall has a capacity limit where, you know, you go to the mall, you will find that they are actually monitoring how many people are in the mall, and at any one time, there's only a certain number of people allowed in the mall, depending on the mall size. Now, despite this, you can see that the tenant sales on the right-hand side has been trending up, but this is actually more sensitive to the dining group as well as the social size restriction on the prevailing safe management measures. So the last few months, the sales has been hovering very near to the pre-COVID level. In fact, in the beginning of the year, we actually exceeded the pre-COVID tenant sales. So it only trended down when the cases increased and we moved towards the heightened alert phases. But it kind of rebounded quite quickly towards the end of August. If you remember, there was some relaxation from the dining in. So people are allowed to dine in again after the National Day. And this has allowed us to kind of the tenant sales to recover quite a bit. But of course, thereafter, the measures were tightened again. So that chart may actually hover around that dotted line around for that period. And we are closely monitoring the effect of the most recent change in the safe management measures. Moving on, some of the leases that will be expiring this year. This year, as in financial year 2022, we have about close to 35% of our leases by GRI coming due, and this represent about 39% of our total area. So we have been actively engaging the tenants in terms of renewals. We have some anchor tenants as renewing. So we are happy to say that we have basically about 25% of these renewals for this year have been actually in advanced negotiation or in documentation stage. So this means that about 1/4 of the leases due for renewal for this year has essentially been de-risked. Moving on, rental reversions. I think this is a question that analysts and some investors always ask. And basically, they wanted to know whether the rents are going up or coming down so that they can represent future rental growth. So we have been guiding the market that because of the challenging markets, the tenants themselves are actually quite cautious about renewing long leases. But again, you have to position to look forward to the future. So as the economy begins to reopen, they are also increasing interest, especially for prime areas. So for us, the year-to-date rental reversion based on the incoming and out versus outgoing, that means the first year of the new rent versus the last year of the outgoing rent, it's just below, it's just negative 0.6%, slightly below flat. But on year-to-date rental reversion, average versus average is positive 2.1. So actually, the leasing market, it is challenging, but I think our strength and resilience of the portfolio continue to underpin the demand for our space. These are some of the names that has come to open at FCT malls. Some of the familiar names like Dong Dong Donkey, and then even SK Gold, you know, jewelers, they open at Causeway Point. And we also continue to attract interesting concepts, both F&B and lifestyle concepts into our mall, despite the COVID. Transition to omni-channel is very important. I think the COVID has basically essentially accelerated the transition for some of the retailers to adopt digital online retailing. So this is in addition to their physical store. So if you were to kind of look at most of the retail landlords, they will have a loyalty program of their own. For Frasers Experience, which is our loyalty program, it comprises the Frasers e-store and the Makan Master. So since our launch, you can see that the sales has been quite phenomenal. We have about 900,000 FRX members, Frasers Experience members, and we are able to tap on this to drive some of them to adopt the omni-channel. Basically, you can order your food from our malls, from a mall that's not near you. And 3 modes of fulfillment: delivery, takeaway, or dine-in. And this makes life quite easy for the consumers. They can have ordering a digital concierge at their fingertips. And for the retailers, actually expands the opportunity to capture more online sales and while fulfilling the orders from their store. So this is actually quite a big change, accelerated from what it was before. Market Master is our digital concierge that help us to pivot a lot of our retailers, our F&B retailers, into omni-channel. This is the strategy that we have wanted to push, and the COVID actually accelerated the pace. And the sales growth have been quite phenomenal, albeit from a relatively low base, but it has been growing quite steadily. And average order size has grown 2 times. And the advantage of this versus the Deliveroo as well as the Panda is that the fulfillment is done by a mall that's near you, so it can get delivered faster, and also consumers can earn loyalty points on our platform. In summary, performance of 2021 has been quite strong. DPU has recovered to pre-COVID level and slightly above it. NPI margin has recovered. In terms of outlook, well, uncertainties from COVID-19 obviously continue to pose risk to our business, but I think the key will hinge on the easing of safe management measures, because this will support the recovery of the tenant sales and support the shopper recovery. Market environment, I think retail space in Singapore continue to be very well balanced between the demand and supply. If you look at the overall market, there hasn't been much big supplies of retail space into the market. So future supply remains low, and the suburban retail prime rent actually has been quite stable even through the COVID. And overall tenant sales, we think, with the relaxation of the safe management measures on the continual basis, we think will help us to recover to pre-COVID level. So on the strategy basis, a lot of people will ask us with a very low gearing, are we going to buy something? I think it's very opportunistic. For our sponsors pipeline, that remains at the North Point City's South Wing, which is the mall that's next to the North Wing, which we own, continues to be our pipeline assets. This property is owned by both FPL, our sponsor, as well as our capital partner TCC. So that mall is worth about $1 billion, and it is currently managed by Frasers Property. The other opportunity is the joint venture in Waterway Point. FCT currently owns 40%, with the other 60% that's owned by 2 other JV partners, 40% by Far East Organization and 20% by Sikit Sri House. So there is some opportunity for us to increase our stake, but that is also quite opportunistic. Now, for third-party opportunity in the market, I think the market is beginning to evolve, where the bigger players will gain momentum, and the playing field in the retail market is also changing. Now you really need to have that digital platform, the loyalty program, and you need to have the scale and the size to really compete effectively in this market. So we think some of the third-party properties opportunity may arise in the near future. So, it's opportunistic, but whatever it is, I think we are ready. All right, so I've come to the end of my presentation, so happy to pass this back to the host.
Thank you, Mr. Chen. We will now proceed to the Q&A session. You may post your questions in the comment section below, and due to time constraints, we will endeavor to answer all of them. I'd like to introduce the moderator for the evening, Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, as well as Mr. Chen Fong-Leng, Vice President, Investor Relations, Fraser Centrepoint Trust, to kickstart the session. So Ben, take it away.
All right, thank you very much, Christine. Fong-Leng, thank you very much for the presentation. Certainly, it's been a very challenging 24 months for everybody because of the COVID-19. We do have a couple of questions that came in through social media, so I think I'm gonna, quickly scan this and ask the ones which I guess are more important. So the first one is the Fraser Centrepoint Trust. Is FCT's focus on Northeast regional malls now?
Well, our portfolio is really concentrated there. It's not by design, but it's a part of its heritage, and a part of it is also because of the ARF portfolio we bought over. We have tried to expand, look at opportunities in other parts of Singapore, for example, the west side, but then, opportunity is quite hard to come by. The last time where the government released the land was in 2014, I think. So that was quite some time ago. And since then, there hasn't been any large GLS site for retail. So we are happy where we are. So if you look at where our location is, it's all on the high population density area. So I think it's a good advantage for us.
And I guess as you alluded to just now in your presentation, FCT is open to opportunistic investments out there, whatever they may be.
Yes.
Okay. The next question is, what is FCT's distribution policy now? Is it quarterly or semi-annually going forward?
Well, we have made the transition following SGX recommendation last year to move towards a half-yearly distributions policy. So our distribution are paid on the first half and the second half of the financial year, which falls on the end of March and then the end of September.
Okay.
April and October.
Okay. And you had that chart in your presentation where you showed the bar charts with the 12 cents and all that. That's your total DPU, right? So
Yes.
whether it's quarterly or semi-annually.
Yes, it's an annual.
Yeah, so it's basically all totals up about the same, huh? Okay. Again, very encouraging to see that the DPU is back to where it was prior to the drop because of COVID-19.
Oh,
so
thank goodness we are back.
Yeah. So that's very very appreciated by the members of the public, investors as well. Next one is a bit of a macro question. How is the rising interest rates by the US Fed in 2022 going to affect FCT's DPU? How much reduction, I guess, if any, can shareholders expect?
I think the rise in interest rate will affect everyone or every asset class that is yield sensitive. So it's not just on FCT alone. I think we have been through a few cycles of this, what you call the tapering tantrum. The most significant one obviously was in 2013. And then after that, we have some series of, in fact, we have a very long period of low interest rates. So any kind of an increase from a low base will look like a very big adjustment. Yeah. But I think for us, obviously being a leveraged asset class, the increase in interest rate will affect our borrowing costs, right? Particularly with the banks, and also in terms of the bonds that we can issue. So for those that we have not hedged, remember I mentioned in one of my slides that we are 56% hedged to fixed. So those fixed ones are relatively insensitive to interest rate movement, at least for the period where it's hedged. For those which are all floating, most of it is on a rolling basis because those are mainly on the RCF, so on a short-term basis, and we have the flexibility to fix them if we want to. So we have always been monitoring the interest rate movement. So far, I think I hope that the black swan event that happened in 2013 doesn't happen again. Right now, there's a lot more liquidity in the market, so we think that any abrupt spike up in interest rate is actually relatively remote. So I think we are okay.
Well, I think arguably the current Fed chair is better at communicating his message compared to Ben Bernanke. So it's a bit of a communication issue previously. So I think the market has also baked it in already. Yes. So yes, you're right. So interest rates are gonna kind of affect all the businesses out there, and certainly it's heartening to know that you also mentioned that more than 50% of the debt load for FCT is already hedged, and you have the flexibility to hedge the rest as well. So that's a very prudent management of the debt loads for a REIT. So the next question is about going forward. So how would FCT perform after the market opens? I guess this is when the social distancing restrictions and all the COVID measures are lessened. And also, what is the growth plan of FCT?
Okay, I'll tackle the first question first. I think we are at this stage where we are really, the nation is entering into endemic, environment, and the government obviously has also wants businesses to recover from COVID. The past 2 years or nearly 2 years has been quite a challenging period for every one of us, particularly in the retail. So for us, I think being a very communal location for people. We have hundreds of thousands of people going through our malls every month. Take for example, North Point City is one of the highest traffic shopper traffic mall among our portfolio, if not among the malls in Singapore. I think the restriction has, or rather the observation in our that we have seen is that there is really holdback of people wanting to patronize the malls, patronize the restaurants and all this.
Latent demand, is it? People
Yes,
pent up and want to,
demand. So if you kind of follow what has happened yesterday, which is the first day of the relaxation of the dining rules, from formerly was 5 under the same household, that now is increased to 5 that doesn't need to be in the same household. You can see the queues forming outside the restaurants. Right? Obviously, for the popular restaurants in the suburban malls and also in Orchard, you can see that people are just dying to go and dine. So we hope that this momentum actually can spill over to other trades as well, fashions, health, health related, and all this that will benefit the retail. So we think if the momentum carry on, this will only help to this will support the recovery to a much better momentum.
Okay.
Now there's a second question towards the growth, right?
Yes, the growth plan or FCT, yes.
I think the growth plan for FCT is actually quite very visible. As I mentioned, in terms of acquisition, we have the 2 properties. One of them is a pipeline from the sponsor, which is North Point City South Wing 17, and has quite stable. Of course, the COVID has posed situation challenges to it. So it's even though it's owned by Frasers, but of course it needs a agreement between the seller and the buyer to make a transaction happen. So again, that is something that depends on the seller's position. And then Waterway Point is the same case. The advantage of these 2 properties is that it's there and we know the property very well compared to third-party assets. These 2 malls is also managed by Fraser, so there's a lot of familiarity. As for the focus, I think for Singapore, for FCT, we are still focusing on Singapore as our core competence. As you know, retail is a very management-intensive business, and you need to have local knowledge. To expand overseas means you need to have overseas experience and local presence. So at this time, we have explored overseas before, mainly because our sponsor have a presence, for example, in markets like Australia, where they have a long history of operating. So that obviously is a obvious choice if we were to go overseas. As of now, I think we have just completed a very big acquisition. So a lot of focus is on the optimizing the current portfolio performance to try to extract the best efficiency out of it. And if there are any local opportunity to spring up, I think we are ready for it.
And I guess it goes without saying that FCT does not want to overpay for any kind of property or asset. Right?
No,
So it's,
nobody will want to overpay.
Yeah. So regardless of the market conditions. Okay, there is a question about Changi City Point. The rental revision is a negative 9.8%. Do we expect to see continued depression in the rents in this area? And what is FCT's plan to raise business traffic into this particular mall?
Changi City Point is a very unique mall in our portfolio because it's the only mall that's without immediate residential population catchment. So the shopper traffic relies a lot on the traffic to the Expo as well as to the Changi Business Park. And before the COVID, actually it was doing very well. The position of the mall has kind of been adjusted over the years. It started off in tapping mainly the Changi Business Park people. So F&B is a very important component. But because of the work from home by default mode, so the shopper traffic from the business park has been severely curtailed. And likewise for the Expo, which actually feed a lot of people into the mall, the big events has also been suspended. So basically, shopper traffic has actually dropped quite significantly. So this indirectly affect, or rather directly affect the tenant business in there. So this is also why the reversion has been quite weak. But I think, it has gone through a very, very difficult patch. But I think with the reopening, you should see better days.
Well, I guess there's tons of people like me. I used to go to Changi City Point every weekend actually. There's this Chinese restaurant. Was it a Tang Lok on the ground floor?
Yes, it's a download. But
Yeah.
more people go there because of the athlete leisure, all the stores for the sportswear. You have Nike, Adidas, Puma, and all this. So they always call it the sports outlet in the east.
Yeah.
So if
and
you
of
want
course,
to look for cheap bargains on the shoes and sportswear, Changi City Point is where to go.
yeah, it's relatively easy to find parking, and of course, there's challenges.
Huge car park, 627 car park.
Yeah. So it's unfortunate that 24 months of this COVID-19 has kind of made people like me stay away, but hopefully we'll start going back again. So the next question is Fraser. Okay, I'm just reading this off. So recently I noticed that Fraser Experience collaborate with Far East Malls. Any additional marketing costs for this arrangement?
Well, I think from time to time, depending on the because I think you're aware that Fraser's Waterway Point is actually a joint venture between the three parties. As I mentioned earlier on, it's between Fraser Centrepoint Trust. It's owned by Fraser Centrepoint Trust, Far East Organization, which owns the Far East Mall, and also Siki Street House. So Siki Street House is basically a Japanese residential developer. So they are there as an investor, but both Far East and Frasers are active player in the retail. So I guess this is probably a very specific collaboration because we co-own Waterway Point. I think for marketing activities, in this post-COVID era, it's important for us to help our tenants to try to promote the sales as much as possible. Obviously, we can't do a lot of physical promotion due to the COVID, but I think the EDMs and those e-marketings is still an ongoing process.
Okay. So in the interest of time, there are only two more questions. We can just briefly go through them. So has FCT explored utilizing the mall roofs for solar panel installation to reduce energy operating costs?
In fact, that's a very good question. Our group-wise, we have been pushing very, very hard on ESG initiatives. Earlier on this year, our group has published its long-term goal to be carbon neutral organization by 2050. So this, because of the size of the group, this is why the 2050 timeline looks very long, but some of the business unit has already accelerated the completion. For FCT, we mentioned 8 of our 9 properties are already Green Mark Gold and above. And in terms of adopting some of the, for example, using the roof for solar panels, Tiong Bahru Plaza and Changi City Point actually have a solar panel installed. Although it does not, the power generator is not enough to power the whole mall, obviously, but it does help to offset some of the energy consumptions. For the rest of the malls, if you have gone to the roof of all these malls, you'll find that actually it's quite congested with a lot of water tanks, M&E equipment, pumps, and things like that. So really, if it's not designed by start and you try to retrofit, actually there's a lot of space constraint. For Tiong Bahru and Changi City Point, we were able to do that during the AEI phase. That means the major renovation. So we set aside the space for that. But for our malls, we have been looking at ways of not only doing emission reduction, energy consumption reduction, water reduction. We are also actively participating in what you call the new initiative called the Distributed District Network Cooling. This news came out in August. We signed a letter of intent with the SP Group as part of the 14 buildings in Tampines Central District to participate in the DDC, which is a district distribution network, to kind of it's a green initiative that helped to cut emission by almost 17% and energy consumption for the next year. And this is a group. This is actually a first of its kind initiative in Singapore, spearheaded by the SP Group. And 2 our malls, Century Square and Tampines One, is involved in that as an injection node for the chiller. This is targeting at for any buildings. The biggest energy guzzler is actually the air conditioning.
Yeah,
a lot of air conditioning are either they're over designed. meaning there's excess capacity which they can actually help some of the other neighboring building to help offset so that overall consumption is lower. So that was the concept. Yeah.
Actually, I didn't know that, but yes, like, and of course the air conditioning is on most of the time. Yeah. Okay. And the last question we have is, will FCT consider acquisitions in the future for foreign malls with similar characteristics as your current portfolio of properties?
I suppose foreign malls mean foreign countries.
Foreign countries, yes.
Okay. That is kind of a very hard, I can't say yes or no, mainly because the retail mall itself is very management intensive, as I say. Location wise, you need to be really have a ground knowledge. You need to know the ground level. You need to know your tenants, the network, and the strength of your brand power is also gives you the bargaining power over the table when you talk about leases. So in Singapore, obviously, the home ground, but moving overseas will depend a lot on what kind of ground advantage do we have. Previously, before we did the ARF acquisition, we did mention about looking overseas, and the most obvious location is Australia, where our sponsor has a very significant presence. They have the logistics, they have the retail, they have all the expertise in there. But with this ARF, I think our attention has shifted back to Singapore, and I think we have a good room to grow in Singapore. So at the moment, our focus is on Singapore.
Okay. All right. Thank you very much, Fang Ling. That's all the questions that we have for members of the public.
Thank you so much for having me.
We're always very appreciative that a big conglomerate or let's call like FCT can kind of answer the questions from members of the public.
We are quite honored to be on this platform.
Okay. All right. Thank you very much.
Thank you.
All right. Christine, so I'm going to pass the mic back to you.
Thanks, Ben and Mr. Chen, for being with us here tonight. We have come to the end of today's webinar. It has been a pleasure to have you with us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS Facebook page. Do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great evening ahead. Thanks, Ben and Mr. Chen.
Thank you, FCT, as well as SGX. Not sure whether Jeff is still around. Okay.
All right. Have a good evening. Bye.